I wanted to make a video and cover energy stocks. These stocks have been underperforming for 2 years. And the reason for it, oil prices. Oil prices have been down, and so have natural gas prices. Now, I don't expect that oil and natural gas is going to stay down forever. And these businesses are really mature, well run, and profitable. So it's not a bad time for me to think about, hey, is there another oil company I'd like to buy out there? And what do these companies look like from an investing perspective? I currently own Chevron, and I own a pretty good position of Chevron. I own Occidental, and I can't complain about either. It hasn't been doing as well as technology, communication services, or financials, but I think they're getting the job done little by little. And if we catch a rally in oil prices, those stocks will take off. So I'm going to go through, and it's going to be a long list of stocks. So fair warning here, it's going to be a little bit of a long video, but I will try to publish the time so you can skip to the company you think is most interesting if that's your cup of tea. And you can take a look at my analysis for each company. Now, let me tell you a little bit about the space, and then we'll get into the first company. So first, my colleague Daryl on live streams, he presented this particular chart. And this chart shows that energy could be the best sector going forward. I think it's a combination of this sector has really been beaten down, has not caught many rallies in regards to stock prices. And really, if the economy does okay and oil prices were to rise any, this sector is really going to perform well. And also show another factor that I think is weighing into, which is natural gas. Natural gas, I think, is going to be in higher demand going forward to produce electricity. I'll tell you more about that in a few minutes. Crude prices have not been overly high. Over the last 5 years, we are probably at an average price. Now, if we can get that oil price, or if oil prices could advance past 75, these companies are really going to move. They're really going to move up in price. And with regards to natural gas, a little of the same. We are kind of on an average natural gas price. If natural gas prices go up, then we've got something, especially for those that are really focused on natural gas production. A lot of analysts are calling for energy to do well. And again, I think it's because stock prices are so low and that they don't have a lot of room to the downside, but they have plenty of room to go up. And with regards to percentages of buy, hold, and sell, energy has the highest percentage of buy recommendations. Data centers are going to need a lot more electricity. And if I look at these statistics, the overall power consumption in 2025 is 2.3% higher than last year. And that's a significant amount. Where is that energy going to come from? Well, if we look at what source of fuel is being used for electricity, the biggest factor or the most common fuel used is natural gas. 43.1% of the fuel used for electricity production is natural gas. Coal is there. And then there's some renewables, but renewables are not as prevalent. The other factor that I think is going to help energy, or I should say natural gas prices, is natural gas is easy to increase, easy to ramp up. What data centers need are turbines manufactured by GEV or Rolls-Royce. And these turbines will burn this natural gas and create electricity, and the data centers will have their power. So I think this is going to be a tailwind, an assister to the natural gas industry, and it's going to raise prices, which is a good thing for these energy companies. The largest cap company I'm going to cover is ExxonMobil. They're $476 billion in market cap. About 10, 15 years ago, they were the most valuable company on the exchange. That's how important this industry is. The PE for Exxon is 15.85 for the current year, 16 for the forward year. And analysts believe it's discounted by 10.85. It hasn't had a great year, but if you measure the 5-year, boy, it's really risen and done quite well if you look at the 5-year. When we look at Exxon, most of their revenues are dictated by the per barrel price that the market's paying, or natural gas prices as well. and that's where their revenues are going to go. So overall, they're profitable. They generate terrific cash flow and have a good balance sheet. 17 analysts cover Exxon, and the most optimistic analyst has their price target at 145. The most bearish analyst is at 105. The downside risk isn't very much, but you have some upside. And I forgot to mention, Exxon does pay a nice dividend. The average discount available on Exxon is 10.85. As we look at the forecast, nobody can predict where oil prices are going to be exactly. And at this point, it looks like revenue is going to be flat. Maybe you see a little bit of rise, but you got to monitor per barrel oil prices and natural gas prices to really see how these businesses are going to go. Overall, they're going to expand their profits. See how this industry has been around for a long time. They have really mastered the process of extracting crude oil or natural gas and then getting it to market, refining it, making products out of it. This industry has learned how to do that over the last 100 years plus. I believe Exxon's a really valuable business. And when I value the company based on their future free cash flows and their future profits, I get a 33% discount on this stock. And that's a really nice discount on a company that pays a 3.5% dividend. Now, these stocks for the past year have been sold off, haven't really rallied, but that may change, especially if we see natural gas prices go up as well as oil prices. If those prices go up, this is going to be a windfall. Investors are going to be paid a nice dividend, and these stocks are really going to flourish. Chevron is the second largest energy company with a market cap of $3.13 billion, and it has a PE higher than Exxon's at 19.87. Forward is 18.41. Chevron also pays a higher dividend than Exxon, pays a 4.43% dividend, while Exxon pays a 3.5. Analysts coincidentally believe it's discounted about the same amount as Exxon. Over the past year, this stock is in the green, and if you consider that dividend, I guess you're probably up about 8%. It's not keeping up the S&P. Over the 5-year, it did do well, up 114% for those who bought shares way back here. This company, like all others in this sector, are dependent on the commodity price of oil and natural gas. But overall, very effectively run company with operations around the world. They just really know how to run their business. Additionally, Chevron acquired Hess successfully, and it's made themselves bigger, and it's going to bring in the Hess assets into the portfolio that Chevron has. It's going to make them bigger, more profitable. That's a big positive. Analysts, 15 of them cover the stock. The analysts are in disagreement of where this price ought to be. We have optimistic analysts at $197 per share, and those that believe that the stock is priced too high at $124 price target. On average, they believe it's discounted by 10%. And like Exxon, they're really going to expand their profits. These businesses are very efficient. They know how to run oil businesses, how to get natural gas to end markets. And if we see those end markets for natural gas being data centers, I think that's going to be a nice tailwind for Chevron as well as anybody else in the industry that produces natural gas and sells it to the market. Chevron is discounted by 6% when I value the company by looking at the present value of future free cash flows and look at the present value of future profits. That's not a big discount. That could change if oil prices rise, but I think Exxon provides a better discount opportunity to investors. This stock does pay a nice dividend, and overall it has been sold off. And let's see how Chevron trades over the next 12 months. SHEL is another integrated large-scale energy producer. They have a market cap of $206 billion, and their PE ratio for the current year is a little high at 32, but next year it's going to drop to 12. They pay a dividend of 3.92%, and analysts believe that it's discounted by 5.7%. For the last year, this stock's up nicely at 9.6. You add that dividend, and you're up there at 11, 12%. Over the 5 years, it's also up 200%. So buying at the right time most definitely is a good idea within energy. When I look at the operations of SHEL, like others in this industry, very well-run company. They have assets around the world that they're extracting oil and natural gas from and getting it to market. So a very well-run company. When we look at the forecast, we have 7 analysts covering the stock. And here, the analysts are a little more in agreement. They range from $70 to $82 price targets, which is a pretty narrow prediction on their side. On average, they believe the stock should be priced at $76 and it's trading at $72. So that gives me a little bit of confidence that, hey, this pricing is probably correct. And it's probably fairly priced with a small discount. Looking at the forecast like the others, it's going to be dependent on oil prices and natural gas prices, and it's going to expand their profits quite nicely. Shell stock is offering investors a 25% discount based on my research. If I look at their cash flows, they're very good cash flows. And they actually drive a 41% discount when I compare the net present value of cash flows to today's stock price. The earnings per share, and you saw that they had a high PE, that doesn't provide a discount at this time, but I put more weight in the free cash flow figure, and I drive towards a 25% discount available on Shell. It's a nice discount with a really nice dividend rate. So Shell is a fairly attractive option for those that are interested in a large energy stock. So far, I've talked about 3 big oil companies that are fully integrated. And what that means is they do everything. They own or have the rights to the places where they're finding the oil. They do the extraction process. They pipeline it over to the refineries. They refine the product, get it to an end usable state, and then distribute it and actually run retail locations like gasoline stations. That's a fully integrated oil company. Now I'm going to talk about companies that only do one area or one step in the overall process, starting with the companies that are out exploring and finding the oil and selling it in its raw, crude state, as well as getting the natural gas found and then getting it to market. The first company I'm going to talk about is Devon Energy. And as you'll see, the market cap for Devon is much smaller. I looked at 3 companies that had in excess of 200 billion in market cap each, with Exxon being closer to 400 billion. And this one here is quite a bit smaller because they just do one area and they're much riskier. The PE ratio is really low at 7.9, forward PE 9.3. They do pay a dividend. Analysts think there's a really nice discount available on Devon. Year to date, the stock's doing okay. It's not a big loser. For the 1 year, it is kind of losing. And for the 5 year, you'd be doing really well if you had bought Devon exactly 5 years ago. Now, Devon Energy most definitely is subject to where the commodity prices go. But this is a good company that has rights to extract from particular areas of the United States. And this company is efficient in how they extract their oil. They produce good free cash flows and are a good operated business. They also have a good balance sheet. The balance sheet's really important for oil exploration or natural gas exploration companies. They can't run out of money or the investors will be tortured. Now, when we look at analysts, we got 19 analysts covering this stock. And the most optimistic price target is $57 per share. The lowest, $40. All price targets are above the current stock price. That's interesting. So they believe on average that the stock is discounted by 26%. Now, this forecast, it's going to be dependent on oil prices going up over time or volumes being higher for Devon Energy. It's a pretty optimistic forecast, in my opinion, that analysts are putting together. There's a lot of analysts behind this. The oil business has been around for more than 100 years, and publicly traded companies that are in oil have been around for more than 100 years. So analysts are pretty good at understanding the industry and putting some pretty good forecasts out there. This forecast looks fairly promising. When I value Devon Energy, I come up with a 30% discount available on the stock. That's a nice, attractive discount on Devon Energy. Their cash flows are very good, driving a nice discount. Earnings per share are good as well. So this is a fairly compelling opportunity for me as an investor. I don't own Devon Energy. I think I mentioned I own Chevron and Occidental. Those are the 2 that I own. I don't own Devon Energy. What I hope out of all this research is that I find 1 or maybe 2 stocks, maybe the smaller stocks that I could start buying into that I think have a very good risk reward opportunity for me. Occidental Petroleum is the next stock. And like Devon, Occidental spends most of its time looking for oil, extracting oil, and getting it in its raw form to market. This is famously owned by Warren Buffett, who owns Occidental Petroleum. This is a $46.69 billion market cap company with a P ratio of 27, and it's going to move down to 19.5 next year. Pays a dividend at 2%. And is discounted 10%. Isn't it funny that I think 4 stocks at this point have been discounted by 10% roughly in this sector? Over the last year, this stock is down 8%, so it hasn't been a winner. But if you look at the 5-year, boy, this has been a winner, up 373%. And back here, Warren Buffett bought more shares, and boy, did he win the best energy stock contest back in 2022. This stock really appreciated for him, going from a stock price of $9 per share up to $74 per share. And I remember Warren Buffett receiving a lot of credit for picking a really, really good stock. He continues to own this stock. Oxy is going to go where crude oil prices go, and to a lesser extent, natural gas. Very well operated company, really efficient in doing their operation. We've got 20 analysts to cover this stock, and their price targets range from $44 per share up to $64. The downside risk isn't too bad. It's just a slight bit lower than its current stock price, but it has some good upside potential. On average, they believe the stock's discounted by 10%. This company is very well run, and look at the expected expansion of profits up in the 20%, 27% range. That's going to be a nice expansion to profits. That looks really good from an earnings per share perspective. I completed my research and valuation on Occidental and think that the stock's discounted by 41%. Historically, this business really produces great free cash flows, and the earnings per share really support the stock price as well because it's expected that they're going to really grow their profits. So overall, 41% discount on Oxy is a very compelling discount for investors to consider. I own Occidental stock, and I've been buying more Occidental stock over time. DiamondBack Energy is a $41 billion market cap energy company, and their P ratio looks pretty attractive. 10.15 for the current year, 12.94 next year. Based on earnings per share, analysts think it's discounted by 33%. And this company pays a dividend of 3.79. A lot of things look good for the stock, but the stock has been selling off for the last year. It is doing well for the last 5 years. That's been the story with these energy stocks. Top line revenue is growing really nicely, but the free cash flow isn't all that great. That is where I'm kind of disappointed or unsatisfied with this particular stock. You see, they haven't had a consistent high cash flow generation like its peers in the same industry. So that is an area of concern. And I used free cash flows as the principal valuation number when I calculate that. The other numbers look quite good. Margins look good. The profit looks good. I think the company has to put a lot of their capital back into the business, which is what is drying up that free cash flow. Analyst, 19 of them cover the stock, and they like the stock. Every analyst believes it's worth more than the current stock price. On average, the consensus is that they have a 33.8% discount available on this stock price. The forecast looks good. They're going to keep growing, which looks good, and they're going to expand their profits. So earnings per share look great for this business. But again, the free cash flows is where this business is not looking all that great. When I run the valuation for Diamondback, I get a value per share that is 11% lower than their current stock price. So in other words, investors would have to pay a premium of 11% to buy this stock. The reason for it, cash flows. The company doesn't produce really high cash flows, and that's the principal way that I value businesses. And it's good to look at a long list of energy companies so we can compare which company has better fundamentals. And FANG, Diamondback Energy, based on the free cash flow fundamentals, is looking like a less desirable business compared to its peers. Petrobras is an oil company located down in Brazil. They also produce natural gas. They have a $79 billion market cap, PE ratio of 12.5, and a really low PE ratio for next year. Really high dividend, 13.36% dividend. And analysts believe it's discounted. Wow, that looks pretty neat. When we look at the 1 year, if you got paid that dividend and you saw your stock price go down about the same amount, you're barely breaking even. So it's not that great of an investment in my book. I'd like to see a stock appreciate because investors want to own the company. Over the 5 year, it's up 77%, not keeping up with the other energy companies that have gone up 150, 350%. When we look at the financials, the top line is going down, but that's principally because the price per barrel price is going down. So it's not their fault. No big deal. They produce really good free cash flows and profits. It is a way to diversify down into the South American economy, Brazil, I believe, being the biggest country down there. Only 3 analysts cover PBR, and they have a favorable opinion on the stock. All 3 believe it should be priced higher. And on average, they believe the stock is being discounted by 23%. Looking at a forecast, it's right there with the rest of the forecast, especially for those integrated oil companies, where it's going to be flat, and it's really dependent on where oil prices go and natural gas prices go. If those go up, they're going to have nice growth. If they stay the same, this is going to be their forecast, and that's how it's going to go. Their profits are going to expand, and that looks good. I did my valuation of Petrobras, and I used a higher discount rate since it is an investment out of my home country. And even with a 12% discount rate, I calculate that this stock is being discounted by 62%. The shares are being sold 62% below their real value. When I look at free cash flows and I look at the future profits that this business is going to produce. So that's a pretty compelling high discount, and they pay that high dividend. So Petrobras is really offering investors quite a compelling proposition. Marathon Petroleum is a midstream producer, and it's been doing quite well over the 1 year. It's up 18%. Over the 5 year, it's up 555%. Wow, that's a really good rate of return. And it pays a dividend of almost 2%. This has a market cap of 58.47 with revenues at 133 million. Now, why has this business gone up when every one of its peers has been going down? I think part of it is that they are a midstream player. So they are paying less for the crude oil and refining that product, turning it into a more valuable product, which is gasoline or diesel. And then there's a different price for that. So I think they're able to make a better profit because they're not held captive to that crude oil commodity price. So I think that's why they've done better. When we look at their financials, they are not growing, but they are expanding their profits. So this business is also charging less because, with oil prices down, gasoline prices go down. Their free cash flows have gone down substantially. Wow, that's a pretty big drop. Gross margins are really, really tight because they are just refining the product and getting it out to market. So the margins are quite tight and the free cash flows have been declining. I don't like either one. I'd like to see cash flows either stabilize, continue on, or grow over time. Looking at what analysts have to say about the company, some analysts believe it's priced at a discount, and some analysts believe that it's priced too high. But on average, they think it's priced just about right if you look at the average. When we look at a forecast for the business, it's forecasted to continue to stay roughly where their revenue number is at now, but their profits are going to expand nicely. So they're going to expand the bottom line while the top line kind of stays the same. I completed the valuation on Marathon Petroleum, and I found that this stock is priced 5% too high. I think that each share is worth $182, but they're selling shares for $192. Now, that's not a big premium, but as I'm showing, you've got a lot of choices just within this sector in this industry. And Marathon just doesn't provide a real compelling offer to the investor to come buy their stock. Enbridge is a midstream player providing a lot of the infrastructure to move crude oil, natural gas from where it's being extracted over to where it's needed to be refined. It's a $109 billion market cap company with a PE in the current year of 23.7, forward P of 22. It pays a nice dividend of 5.39. Over the 1 year, it looks really good, up 22%. Over the 5 year, up 69%. Not quite as good as other energy players in this space, but this would be a more stable company. When we look at other factors in the stock, The business is growing nicely. Again, they're not subject to the commodity price because they're just moving the commodity itself and they're charging to do so, the transmission lines. Now, when we look at free cash flow, they have grown, but then contracted the free cash flow a bit. The gross margins have gone up and down, but now they've been coming down a bit, down to 41%, and profit margins are 9.65. Taking a look at other factors weighing on this business, let's take a look at the balance sheet. And here, this business has less than $1 billion of cash, but they have $74 billion of debt. That's a lot of debt. And the debt to EBITDA is 6. That's a lot of debt. And these transmission lines do cost a lot of money. But again, I'm going to keep repeating it. A lot of debt means a lot of risk. And that is well above my maximum, which is 3 of EBITDA to debt. So that is kind of a showstopper for me on this stock. Now, analysts using just earnings per share think the stock price is discounted any way you look at it. And in fact, on average, they believe it's discounted by 22%. When we look at the top line growth, that looks fine. It's flat. And the profit's going to grow on the bottom line. But again, I keep coming back to that debt level. The reason I check the balance sheet on these companies is I don't want to buy a business. It's just really hampered by excessive debt. And that's what we're dealing with here. I completed a valuation on Enbridge, and it's not a pretty picture. That debt's showing up again. I do get a good intrinsic value of their free cash flow. But what I like to do is I add cash and then I take away debt. And when I do that, it really drops the equity value. There's very little value left. Most of the company is owed to whoever owns their debt. Therefore, it's actually a pretty drastic premium that an investor would pay for a business that's so indebted. On the earnings per share, it's not as bad, but it's still not positive. So overall, this is a business that's priced 68% too high. Now, I may be off by a little bit, but you get the picture. That debt is just bad news. This is not an investable business for me. Energy Transfer is also a midstream player, providing the transmission of commodities from where they're extracted over to where they're going to be refined or where they're going to be used in the case of energy or natural gas. It's a $58 billion market cap business. PE is 13, forward PE is 11.9. Big dividend, 7.77%. Over the 1 year, it's up 5.86%. I guess if you add the dividend to the appreciation, that's not bad. And over 5 years, 213 isn't bad at all. And look at this chart, nice and smooth going higher. Energy Transfer, getting it done for investors. When we look at their revenue, it's more stable than an energy company because, again, they don't have to pay or be subject to the commodity price on oil or natural gas. They're just transmitting this energy from one place to another. So it's been more stable, and they've been able to generate cash flow and profits along the way. Their cash flow has been more stable. It is down a bit. Looks like in the trailing 12 months, it's down quite a bit. Their gross margins are a little low, down to 20% or so. And the profit margins are a little low. 5.55% is nothing to write home about. And their free cash flow yield is 7%. So the numbers are not incredible, but it's been a very good, stable company that has had a stock price that's appreciated for the last 5 years. So there's a lot to say about that. Let's take a look and see what analysts are saying about this stock. Now, all analysts believe this stock is priced at a discount. In fact, together, the average is that the stock is discounted by 32%. They are weighing that on earnings per share and looking at the forecast. They're going to keep growing, which is really, really impressive. Again, whether oil prices go up or down, they just get paid by the volume that they're moving. The profits are also going to expand for this business. That looks good. So that's why investors really like this stock, is the stability and being able to play in the energy markets. I completed a valuation on Energy Transfer, and I get to a 13% discount on the stock. That means that each share, based on my research, is worth $19.59, but the market's selling stock at $16.99. The free cash flows get me to about a 6% discount. One of the primary reasons why the value is held back is the debt level. They have $61.5 billion of debt, and that's a lot of debt. In fact, it's more than 4 times EBITDA on the debt level. And that's above my limit. And I wouldn't invest in Energy Transfer, and it really pulls away from the overall value of this business, pulling it down to only a 6% discount. I also increased the discount rate because it does have a poor balance sheet. It's not terrible, but it's not good. Now, earnings per share does reveal a nice discount available if you just use earnings per share of 25%, combined 13% discount. Again, what's good about looking at multiple stocks in the same industry, in the same sector, is you can see which company gives you the best, most compelling opportunity to invest and make money. This one is not overly exciting. It's just there. I tip my hat as to how consistent the stock price has gone up, but I think the other stocks have a comeback in store for them that could really, really benefit investors. This one here might really lag the other energy companies over the next 2 years. Another midstream player is Cheniere Energy. They move predominantly natural gas. This is a $51 billion market cap company with a PE of 13.5 for the current year, and next year will be at 17.6. Pays a small dividend. The stock has really worked for the last year, and the 5-year looks excellent. And look at the trajectory of this chart. It's just gone up over the last 5 years. So this has been a superstar stock if you consider the appreciation and the rewards to investors that this stock has delivered. When you look at the financials, the revenue did contract for a couple of years. It looks like it's growing again. It had some boom periods when oil prices and natural gas prices were really high in 2022. The company has, let's take a look at free cash flow. Free cash flow has been going down. It's interesting that the stock has really held up. On the gross margin level, gross margins were as high as 83 in 1 year, but they've stabilized down to about 47, and margins have been all over the place. It's interesting to see that. And profits are pretty decent at 21%, and free cash flow yield is about 13%. Let's take a look at the forecast of what analysts have to say about this stock. Analysts, some of them believe that the stock could go up higher, much higher, and others think that the stock's just slightly discounted. On average, they think it's discounted by about 13%. They think the business is going to continue to grow and profits are going to expand a little bit. So this stock has what they think is a pretty decent future. Let's take a look at the balance sheet and see what kind of debt level we're dealing with. These guys carry $26.37 billion of debt. They have about $1.7 billion of cash. So they have a net debt balance of $24.6 billion. Debt to EBITDA is right at 3, right at the limit. So let's take a look at the valuation now for Cheniere Energy. I completed my research and my valuation for Cheniere Energy, and I come up with a 32% premium that is being priced into the stock. In other words, I think each share is worth $158, but they're selling for $232. That's a 32% premium. It's mainly on the cash flow side, just not enough cash involved that's coming into the business. And you have this debt level that a decrement from the overall value. So this is not a stock that I would be investing in. Even earnings per share doesn't get to the stock price. The stock has flourished for 5 years. It's done great, but I'm not here to buy stocks that are maybe popular or maybe have had a very good 5-year run. I'm trying to buy stocks that are unappreciated, discounted, and are going to have a very good 5 years going forward. EQT is a pure play natural gas company. They extract, transmit, and get to market natural gas. It's a pure play natural gas play. And over the last year, this stock's up nicely, 53% over the 5-year, up 334%. They may be benefiting from the demand from these data centers pulling all this natural gas. The market cap, $35 billion. The PE this year is 29, but it's going to drop to 14.8. They pay a small dividend, and the analysts believe it's discounted by 9.6%. They had a big spike in revenue, 60% growth this year. That looks really good. Now, I checked the commodity price on liquid natural gas, and it's not that high, but these guys are really booming. They have really nice growth of cash flow. That looks really good. And then the gross margin is really, really high. So things are really happening over at this business. Really good things are happening over at EQT. When we look at the forecast, we've got 21 analysts covering this stock, and they are in disagreement of what this stock is worth. The most optimistic analyst thinks it's worth $80 per share. The most pessimistic, 40. So on average, they think it's discounted by 9.6%. When we look at the forecast, they're going to grow nicely for the remainder of 25. 26 is going to be a good growth year, and then they're going to flatten out. So the growth is going to persist for the next year and a quarter, and then it's going to flatten out. And profits are supposed to wane as well. So that'll be interesting to follow to see how they continue to grow or if they stop growing at all. EQT has a 20% discount available to investors, and that's not overly compelling. This stock price has been going up. I think they're in a really good space. If I could get a 35% discount on this stock, I'd be all over it. For now, I'm going to follow this stock and see if it could drop a bit before I enter a position in it. I really like their pure play natural gas uh, for the data center fuel market. I like that whole story, and I'd like to track this stock and get into it at some point. The discount at 20% isn't overly compelling for now, but it does support the stock price. 25% discount if I use cash flows, 9%. And I agree with the analysts, by the way. Their average was around 9.6. My earnings per share valuation is at 9, so I agree with them. So overall, this is a really good business. It's just the stock price has gotten a little too high. That's my only complaint. So I'm going to see if I can get the stock price down, maybe to 25% discount, and then I'll enter into EQT. But it looks like a really good business for the times. And the final stock that I'm going to cover is Valero Energy. This is a downstream company. And what that means is they don't have to extract the oil. They don't deal with the commodity price per barrel or liquid natural gas commodity prices. They are basically refining or buying from refineries and then selling the gasoline or diesel to the retail customer. This company is a $52 billion market cap business. P ratio this year is pretty high, but next year it's coming down 15, pays a dividend of 2.7. This stock has worked for 1 year and it's worked for the 5 year. This has really worked for investors. And this is not held captive to that commodity price again. Although their revenues have been coming down, it's interesting that the market is buying it up while their top line has been going down. Let's take a look at free cash flow. Free cash flow has also come down over the years. Isn't that interesting? Their gross margins are not looking good. So it's interesting how the market is buying into this company, even though the fundamentals look like they're really, really coming down. Profit margins, really very little profit involved in this business. It is retail, petroleum products, diesels, and so forth. And there's not a lot of margin there. A lot of volumes, but not a lot of margin. So this business here, although it's been doing well, I just don't like the fundamentals. I think I find better fundamentals from its peer companies. Looking at what analysts have to say about this business, one analyst believes it's a $200 stock. Another analyst believes it's overpriced. It's a $136 stock. I would say that combined on average, they think this stock's fairly priced. And when we look at the forecast, it's a forecast. It's pretty flat. If anything, it's contracting a bit. The profits are expanding. That's where I think the market is excited. You see this, the expansion of the bottom line by 27% next year, then 19.6, then 19 over here. So those are pretty good expansions to the profit line that investors may be excited about. I did my research on Valero and also did a valuation. And I think this stock is priced at a 12% discount. Each stock is worth $191 per share, and the market's selling shares for $167. The free cash flows do support a higher price, but the earnings per share don't support a higher price. It actually shows that the stock is being priced 12% too high. Together, it's a 12% discount available to investors. Now, this isn't compelling, and I think a 12% discount is okay. They don't pay a high dividend, and I'd rather go with one of the other options in energy. I think Valero is a good business, rewarded its investors, great job. It's just not compelling enough for me at this time. Well, you made it to the end of the video. Congratulations. This has been the longest video I've created. So I won't make it any longer and just get right to the heart of what the video is about. Which one is the best investment, in my opinion, and which one is the absolute worst investment, in my opinion? The best investment, if you want a big cap stock, ExxonMobil, a very high discount, an excellent dividend, and a business that has been proven to really rally when when oil prices go up. And I think ExxonMobil has been kept down from a share price for the last 3 years, and it's probably going to rally higher. So just ExxonMobil, I think, has a great proposition to investors. Second place would be Occidental. I think Occidental has a lot of upside potential. It's discounted. It pays a dividend. I really like Occidental. I also like the size of Occidental. So those are the two best. The next category is good, but not the best. And good would be Chevron. Good dividend, not a great discount on the stock, but it's a good company. Devon, good stock, good company, but it's just good. It's not one of the best. Petrobras could potentially be a great return on investment. It's just riskier. And that additional risk kind of makes me shy away from Petrobras, but I think it could be a great investment. But for now, I'll leave it in the good category. EQT, I'm excited about this business. I think the pure play natural gas play could be something special. So I'm going to keep an eye on this stock and maybe even buy into it if I could see just a price reduction over time. So now we're going to move from the best, the good. Now I'm going to say some marginally bad, marginally good companies. First one being Shell. I think if you're going to look at a big, fully integrated oil company, you got Exxon, you got Chevron. Both, I think, are better than Shell. So if you put them next to its peers, I think Shell doesn't stack up. Energy Transfer. It's just not compelling to make an investment in Energy Transfer. I think it has done well. It's a midstream player, but I think the best days are behind this particular company. Valero, it handles downstream operations. It's done well. It's rewarded investors, but I don't think there's much left in this particular stock. So those are the marginally bad stocks. Now let me go over the worst. And I'm going to start with the absolute worst one, and that's Enbridge. I was kind of shocked with how much debt they carry. That is a really risky proposition. You're basically buying a company that has so much debt. I don't see how they're ever going to get out from underneath that debt. So I'm really just shying away from this stock altogether. We'll see how things play out for them. But that debt just really scared me away. Cheniere is also not a good investment. It's not discounted. It doesn't have much of a proposition to the investor. And I would shy away from these two. Enbridge being the worst, Cheniere being near the bottom with them. The next two are not absolutely worst. They're kind of just bad. Marathon Petroleum and DiamondBack Energy. The discounts aren't there. The businesses, I just don't think are going to do well going forward. And I would just not want to invest. I wouldn't want to invest on anything that's kind of halfway to the side where the worst category is at. These would just be uninvestable for me. I couldn't argue with somebody that wanted to buy Shell as an example. And everything on the best side, especially Exxon and Oxy, would be, in my opinion, just really good buys at this time. If we see oil prices go up, these stocks are really going to move. And oil prices have been down for a while. If we just get a rally in oil prices, I think owners of these stocks are really going to celebrate that day. And the natural gas play to serve the data center with the electricity needs they're going to have is also a play that I'd like to keep an eye on. So I hope you enjoyed my video looking at the best to the worst stocks that are available in the energy markets. Hope you found it interesting, and I appreciate you watching. Thank you for watching my channel. It's been really fun and satisfying to have a channel for a couple of years. I've met a lot of great investors, and together we've really grown. And I wanted to offer you the opportunity to become a member of the channel. It'll give you more access to valuations, research, more access to more videos, the tools that I use, as well as being more connected with me, as well as other members of this channel. There's 4 different levels. Take a look and see if one of the levels is something you'd be interested in. I think you'll benefit from being involved, and I hope to see you soon on one of the member calls or on Discord.